Okay, here's Sarah's question. Given that Facebook just bought WhatsApp for ridiculous valuation, even though it has no revenue, are you concerned about a bubble bursting a la the early 2000s? It's really a good question. And there's a long delay. Thanks. Okay, then I won't be mad at you for not typing right away. That's okay then. I forgive you. Okay, so the answer is this. There are in the 2000s there was a widespread overvaluation of tech stocks that had basically, if you look at their PE ratio, which is their price to earnings ratio, you saw that those companies had no earnings or negative earnings compared to their prices, so that certain stocks were far, their valuation was crazy, was nuts. And in this market, we see an overall valuation bubble a little bit, but nothing like we saw in 2000. And also, it's very spotty. In other words, if you look at a company like Amazon and look at their PE ratio, it's astronomical. I'll look it up real quick. It's something like 100 or 200 or 300, which is insane, where the market right now is about 18 or 19, maybe 20. Let's just take a look at what the PE ratio is for Amazon. I was crazy. It's 587, which is totally insane. If you look at the PE ratio for Google, even though Google is, over $1,200 a share, the PE ratio is 34. So the PE is still very high, but the growth rate is very, very high as well. The PE ratio for Apple, for example, is 13. So that's actually below where the market is. It's almost like a value stock, if you can believe it or not. So no, I don't think that this is a sign that there's an overall bubble, but I think there are certain stocks that are absolutely in a bubble. Okay, thanks, Sarah. Good sense of humor. Got another question from Michael Packer. What's your thoughts on the market in Europe? When do you see them coming back? Okay, I have a crystal ball. Unfortunately, it's broken. So it's impossible for me to say exactly when the market is going to come back for the European stocks. However, what I think is a much better way. Okay, obviously there's an ebb and flow, so that when enough people have sold and enough people have become pessimistic about the European markets, and there's no more sellers, that's when the market will come back up, when there's an extreme, let's say, depression emotionally, when there's an extreme pessimism about the European market. That's when the market will start coming back in Europe. The Europeans have tightened. They have made their economic system much more. They've tightened as a result of their financial problems, as opposed to trying to print their way out of the markets, as we've done in the United States. So they're going through an austerity that is deeper and longer than what we went through in the United States. However, it may be in the long run that their strategy was better. We only know that in the long run. So my philosophy about markets and investing, rather than trying to predict the future, the methodology that I use is I just look at the market itself and let the market sort of tell me where it is. So I wouldn't ever try to anticipate it. I would wait until the market actually did show strength before I would buy into funds in Europe. Okay, what percentage of our, Sarah, back with another good question. What percentage of our portfolio should be in individual stocks and what percentage should be in ETFs? Okay, this is a very good question as well. So I believe that you should not even start to invest unless you have a strategy. So there's a lot of different strategies. One of my favorites was created by William O'Neill from the Investor Business Daily. He's got a book. He's got a number of books out about how to pick stocks. And I think that's a decent methodology. If you want a methodology about ETFs or mutual funds, you could buy my book, or you could read about it on my website, wealthpilgrim.com. But there's a lot of different strategies. But the point is that I don't recommend you buying individual stocks because you have a feeling about it. I think that even if you get it right once or twice in the long run, if that's your strategy, if that's the track that you're running on in the long run, you're going to get derailed and you're not going to do well. It's hard to be lucky all the time. You might be lucky a few times, but not in the long run. It won't stay with you. So the question of stocks or individual stocks or ETFs is really a function of what your strategy is going to be. If you're a very involved investor and you like getting, you have a strategy, a foundation by which you decide what stocks to buy and what stocks no longer to own, when to sell them, then terrific. Then you follow that strategy depending on how much your account values are. If you have $10,000, you might have 2 stocks or 3, according to the Investor Business Daily. But again, and this is something I really like about William O'Neill, he said even if you have $1 million portfolio, you shouldn't have more than 10 stocks. And I believe that because it's what I notice when people have 20, 30, 40, 50 stocks is they just stop watching them. They stop paying attention to what's going on. And that's dangerous. You want to definitely watch what's going on. So depending on how active you want to be with your investments, you should either have stocks or ETFs, in my opinion. And ETFs and funds are more suited for those people who are a little bit less involved, a little bit more passive investing. And if you're individual stocks, then you're going to be very much involved. You cannot buy them and forget about it. That's my opinion. Yeah, so that's the way I would do it with individual stocks. I hope that answers your question. Do we have any other questions in there? I know there's a delay, so I'm going to wait patiently. Yes, it will be recorded, by the way, but I might get rid of the recording because of the problems with the technology. If you have a problem with it being recorded, let me know and we can talk about how to take care of that. Next question. Sarah is a very anxious investor. Where do you see the future of natural resources, natural gas and precious minerals going? Are they a good way to hedge against stocks like tech? Okay, this is also a good question. Sarah, you've been doing your homework. First of all, I'm not an expert in natural resources. I'm not an expert in gas and oil. I recently did a seminar, and unfortunately, when you present a seminar, you got to prepare for it. So I did some research, and I found out that the United States is the world's largest producer of oil, which was astounding to me. And I know that the natural resources, the natural gas is right up there. I'm not an expert with natural gas supplies and markets in the United States. But traditionally, precious metals and natural resources do really well in a high inflation period. And that's not what we have right now. Yes, we're going to record it. Okay, no problem. Yes, it'll be recorded, and I'll let you know how to get the hold of the recording. So hold on, Sarah. And your husband does get credit. All the credit goes to him. So, it's not to say that natural resources and precious minerals only do well in inflationary periods, but they tend to do better when there's high inflation. And when there's low inflation, they tend not to do as well. That would argue then that over the long run, well, over the foreseeable future, natural resources would not be a good way to invest. Number one, a lot of natural resources are coming online. More oil is coming online. The amount of oil that is used, at least in the United States, is going down, and across the world, the usage is going up. But there's more production coming online. Inflation is low right now. I don't think it's the best bet, and I think it's smart to be thinking about a hedge against stocks like tech that have done really well. But, I think it's a little bit better to be a little bit more proactive with your investment strategy rather than wait, that maybe someday there will be inflation as a result. We should have precious metals. I mean, look at what's happened to gold. Gold has basically fallen on its face in the last year. In 2013, it did horribly. And that's, I think, a result of the fact that people understand that inflation is not a problem right now. So, yeah, I'm not a big fan right now of natural resources and precious minerals. Instead, I think you should have a strategy that looks at what's going on right now and move your investments around as a result of that. Michael, back with Michael. What is your way of thinking right now about growth or dividend stocks? Traditionally, dividends have been a big contributor to the return of stocks. I think it's about a third, if I'm not mistaken. And so for the long run, dividend stocks I think are a good move for the right investor because they provide income right now. Everyone loves income, and a good chunk of your return. So for the right investor, if you pick the right stocks, that can be a good move. But the problem is that some people look for dividend stocks and that's all they care about is the dividend. So what happens is with dividend stocks is that, for example, people buy what's called MLPs, master limited partnerships, or stocks that pay high dividends and no growth. And what happens, that's a huge problem in my opinion, and historically it's been proven out. What happens is if a stock is only paying high dividends and there's no growth behind it, like for example, an MLP, which is more tied to oil and natural gas, etc. If there's a problem with that dividend, not only does the dividend get reduced, but also the stock price falls on its face because no one wants the stock anymore. So it's actually a very aggressive portfolio if you're only buying stocks just for the dividend. As long as the stock is a diversified company, strong company with lots of years of increased dividends and high payout, not necessarily a high payout. You want to make sure that they actually pay out a moderate amount of their income because they want to reinvest in the company to grow it. When you get a company, again, like an MLP, where they invest, I think, 95%, they have to pay out 95% of the dividends, then there's no money going into the company, and that, I think, is flirting with disaster. I've seen big problems with that in the past. So as long as you're looking for growth and dividends, I think you're in pretty good shape for the long run. Okay, back to Sarah again. Yes, you will have a recording. What other advice can you give to a young couple just kind of starting out financially and wanting to save a nest egg? This is, I would say, a great question. I'm not going to say the best, but a very important one. And actually, in my opinion, it's much more important than asking about an individual stock or anything like that, because what Sarah's asking about here is trying to get a strong foundation. If you have the strong foundation and you build around that, then if you're buying one stock that isn't exactly the best or one fund that isn't exactly, you can recover from that. But if you don't have a strong foundation and you're making aggressive stock picks or you're keeping your money in the side and not investing it appropriately, that can be catastrophic. So I'm glad you're a young couple, and I'm glad you're asking this question. So I have a lot of material on. I'm going to do a shameless plug for my website, Wealth Pilgrim. But so if you go over to Wealth Pilgrim and sign up, there's a lot of good articles. And there's also, for anyone here, if you send me an email, I'll send you a book that I wrote called Money Academies for Couples. Money Academy for Couples. And it's a very good book. I'm happy to send it to anyone who shoots me an email at neil.pilgrim@gmail.com, and that will answer your question. But let me get to that. So the first thing to do is to be really clear with each other about your goals, what you want to achieve. Because you never want to assume. If you assume, you make an ass out of you and me. Don't want to do that. But you want to get on the same page with your husband or if someone, with your partner, your spouse. Very important to make sure that you really are clear of what you want to do and when you want to do it. Once you do that, the next important thing to do is figure out how much money it's going to cost you to do these things. Excuse me. So, for example, let's say you want to save for a house, and you want to save for retirement, but you also want to have fun, you want to travel, all these things. So you set up targets for each of these things, and what you want to do and when you want to do it, and you automate. The biggest part of that is that you automate that savings. You automate it. So you figure out you'll need to put $100 a month for travel and $300 a month for the house and $700 a month for retirement. So that's a total of $1,100 a month. So what you would do is you would set up 3 different investment types of accounts, and then you would automate that. So in the beginning of the month, that money would automatically be taken out of your account. You don't have to think about it, and there's all you can do all kinds of sophisticated tracking, and it's good to track your spending. And I use a program called YNAB, and all my daughters do. You can use any number of programs, and I've written a post on how to track your finances in 5 minutes a month. And if you go to my site and just input in the search bar 5 minutes, you'll get it. But the bottom line is those tools are good to help you identify the money that you could set aside. Okay, if you look and see where you're spending money, then you can easily say, well, I don't want to spend money on coffee, I don't want to spend $100 a month on eating out, or whatever it might be. So you can identify the money that you want to set aside. And once you do, then at the beginning of the month, the very first thing you do is put that money aside and get it out of your checking account so you can't spend it. That is the number one. That's the secret weapon of financial success. If you automate your finances so you make your success inevitable, basically. That's the best thing. Now, don't freak out since you're a young couple, and if you don't have that much money to start off with, let's say you go through your budget and you figure, okay, well, we can save about $500 a month. Start off with automating $250. Do half of it and get some success under your belt. Make sure that you can succeed. And then once you've been able to do that for a few months, then you ratchet it up a little bit. Okay. Any other questions? I see I've got a lot of good friends here on the Hangout, and I really am sorry, by the way, that that we can't see you and talk to you and hear you. I don't know why that is. But are there any other questions that I can answer? And I'll be patient again because there's a delay. And if any of you want to volunteer to help me make my next Hangout even more successful technologically, I'll send you 2 of my books. But you got to make sure it works because this is crazy. Okay, so Adam, nice to connect with you again. How much do you use the cash flow modeling in your practice? Is it helpful? Okay, so I just need to understand that from you. Are you talking about cash flow modeling for investments or cash flow modeling for clients? Because that, while I'm waiting for your response, I'm going to explain what that is. Cash flow modeling is basically looking on a client level, looking at how much cash they can, how much cash a client can set aside every month. Cash flow modeling from a stock or company standpoint would be looking at their cash flow and determining, what the valuations are. And personally, to answer the 2 parts of that, from an investor standpoint, I definitely use that because the cash flow is what it's all about. We want to make sure that the client has the cash flow to afford their lifestyle, and also we look at the cash flow to determine how much we can set aside, and we look at that all the time. That's a critical success factor in my experience. With respect to stocks, I don't buy individual stocks. I buy funds and ETFs. So I hope that answers your question. Anybody else out there want to sort of get anything answered? Okay, I think I answered it, Adam. So yeah. Okay, Sarah. Our portfolio from our wedding savings was up 14%, and we decided to take some out. Is it a bad practice to cash in when you are up? Absolutely terrible. Or should we let it ride when the going is good? So, when you do that, when you take money out when the market is good, what you're doing is you're trying to predict the future. And again, that's what my experience tells me, that when people do that, it's more of an emotional, there's more emotions to it than there are a strategic or tactical standpoint. So if your strategy calls for taking money out when the market is at X or up a certain percent, there's nothing wrong with that. My guess is, though, based on your question, that it's not according to a given set strategy. I'm a big fan of investment strategies. You got to remember, especially you, because you're a young couple and you got a lot of years ahead, a lot of investing. Okay, so it's not about making the best move with every single buy or sell decision. It's about the strategy that's going to maximize your net worth and peace of mind over, many, many, many decades. So what you did is kind of predict, and maybe you made a good prediction, but over the long run, it'll be very tough for you to consistently get that right. So rather than invest or divest based on market levels, I would use other criteria personally. So one of the things that I look at in the market is the percentage of bullish versus bearish. When there's too many people that are bullish, that is a red flag for me. I look at the market versus where it is on its 50-day or 100-day moving average. That's another either red flag or go-ahead light for me. And there's a number of other things I look at. What are the strongest stocks doing? Are they doing poorly? Are they doing well? I look at overall market indicators. And again, if you want to get more information about that, I strongly recommend that you pick up Bill O'Neill's book on how to invest in the stock market. He's got some very good indicators there. But however you do it, make sure you use a strategy. Don't do it just based on how you feel in the morning. I think in the long run that's going to go against you. I could be wrong, but that's my experience over the last 30 years. What else can I do for anybody out there? Anything else? I could break into my jokes, but my daughter told me definitely not to do that. That would be a big mistake, so I'm going to spare you from that. Okay, so I think I've answered your questions. Nope, yep, no more questions. Okay. I really appreciate your patience. I'll try to work this out. So I'll test it out with a few people. So to make sure next time we'll have a little bit more interactivity, which I think might be a brand new word. I'm not sure, but we'll have a little bit more interaction rather than just me reading your notes. I apologize profusely about that. But shoot me an email if you want to get a free copy of my book. If you're willing to help me on the technology side of this, I would really appreciate that too as well. But I thank you very much for coming to the Hangout today. I look forward to any questions you have in the future. We'll do it again, and it'll be smoother sailing, I promise. We're getting better every time. You should have seen the first one we did. It was even worse. So thanks very much for your patience, and I hope that I've been of service to somebody out there today. Thanks. Oh. Okay, Sarah, I'll answer your question. I think we've ended. I'm not sure if anyone's still on, but okay, we got one last question before, and by the way, thank you for your help. I'll take you up on that offer because I'm not doing right. But here, Sarah's asking me one other question. We have a fund that was set up in such a way where we cannot take anything out for 5 years. We were split between just individual stocks. Sorry, I'm reading it too fast. It was set up so that they can't take anything out for 5 years. That's weird. It might be an annuity. Currently, we are pretty split between ETFs and individual stocks. The individual stocks were chosen based on some research, but we aren't pilgrims. Not yet. Are you suggesting we should get out of individual stocks? Not really, not necessarily. I'd want to know more. That sounds like a really strange investment. I have never heard of such a thing unless it's an annuity. But I'm assuming that within that investment, you might not be able to take money out of the shell of the investment, but you can move money around. And while I'm speaking about this, maybe you could chime in and tell me. Okay, so hold on one second. Okay, good. Fine. Let's see. Okay, sorry about that. Let me go back over here. Okay. So if it's an account where you can't take anything out for 5 years, if it's what's called a tax-deferred account, it's actually much longer than 5 years. It's until you're 59 and a half, where you can't take money out unless you want to take a penalty. So annuities, generally speaking, I really don't like. And maybe we can talk about the next hangout. Talk about that at the next hangout. Let's see. Hold on a sec. Okay. I got to plug in, otherwise I'm going to lose power and make it really bad. Okay. So, Um, Again, I would come back to your strategy. Even if you can't take anything out for 5 years, the thing to think about is, okay, let's assume that it's not a tax-deferred annuity, whatever. What is your strategy with that pot of money? And first of all, if you're investing for 5 to 10 years, there's nothing wrong with having equities, so stocks or ETFs. So if you have a well-articulated investment strategy, keep the individual stocks, that's fine. But if you're doing it based on a gut feeling, it says here that you did some research at the time. Yeah, I mean, if the stocks have done well and if your research proved that you knew what you were doing when you did the research, in other words, you did research, you concluded that certain stocks would do well, were worth a good bet, and most of them did well as a result, then there's nothing wrong with that. Continue to do your research and see if those stocks are still stocks that you would hold today or that you would buy today. If you own stocks that you would buy today, then hold on to them. If not, I think ETFs are a better bet because they're going to reduce your risk. Obviously, when you go to the ETFs, and again, if you don't, by the way, if there's someone out there who doesn't know what an ETF is, you can go to the site and there's a lot of information that talks about what an ETF is. But it's basically like a mutual fund, only very inexpensive. So the ETF is going to reduce your risk, but it's also going to reduce your potential return. I mean, if you have all your money in 5 stocks that all do really well, as opposed to 5 different ETFs or 1 ETF, then you're not going to do as well. By the way, also, sometimes ETFs can be more aggressive and more risky than individual stocks. If you put money in an ETF that's very narrowly focused, like, for example, a gold ETF, or an oil ETF or something like that, that can be extremely aggressive. ETFs can also be very broad, like the S&P 500, et cetera, et cetera. So all things being equal, if you have a broad-based ETF versus individual stocks, the ETFs, and if you don't know what you're doing and if your research hasn't really proven itself, look at how your stocks did versus the S&P 500. And if you didn't beat it, or even if you did beat it, but you think you did it by luck rather than based on your research, then I would reduce your risk and go into the ETFs personally. And by the way, I'm happy to talk with you and your husband if you want to give me a call. It's no problem. Okay, anything else for any pilgrims or not, or soon-to-be pilgrims? Okay, so basically what will happen is this will be on my YouTube channel, which is, you can look it up under Neil Frankel or Wealth Pilgrim in YouTube, and you'll see a replay of this. It'll be up in a little bit. Shoot me your email, and I will send you the book, and then I'll keep you posted on the next Hangout. And that Sarah and her husband will help me make sure that works even better than this one did. So thank you very much. Thanks for hanging in, and I appreciate your support. Thanks for the opportunity to be of service. Bye.
For more great ideas on how to have no money worries no matter what, come on over to wealthpilgrim.com, sign up for your free weekly updates, and get a free e-course on how to make better investments.